Mode.
Today I'll be discussing on the issues on the application of IFRS 9 and fair value measurement for Islamic financial instruments. So this is basically the continuation from the last 2 weeks presentation on the integrated Sharia assurance model, which I highlighted on the internal role, the role of internal auditors and the role of external auditors in order for them to conduct Sharia audit. But for today's topic, it will be focusing on the issues relevant to external auditors, which is on IFRS 9 and some new features of IFRS 9 that was introduced by IFRS. And then and today will be also the last presentation for me during my active visiting scholar session, which my term is finishing. So for the to the audience, can you actually listen to me? Okay, so this paper actually was written by myself and a co-writer, Professor Abdul Rahim Abdul Rahman. Both of us are from the Faculty of Economics and Muamalat, University Science Islam Malaysia. Okay, so we shall start now on the issues on hand, that is on the IFRS 9 application for Islamic financial instruments, and also discussion on fair value measurement. Okay, so the outlines for my today's presentation will be on first the classification and measurement issues of Islamic financial instruments, and the second one is the Sharia issues on fair value measurement of Islamic financial instruments. And for the first issue or first part of the presentation, it will be on the classification and measurement issues, and I broke the issues into 3 sub-issues, that is, and I will explain first on different type of Islamic financial instruments that we have. And because we know that Islamic financial assets, there are various type of it, and some are fixed rate and some has variable rate. And so this engagement, the different type of rate now is affecting the how it is measured, whether it's to be measured based on amortization, or is it to be whether it will be amortized, or whether is it to be recognized and measured as a fair value. And issue 2 will go through the concept of contractual cash flow characteristic tests, and because these tests will raise the issue of the allowability of interest, revenue and expense, and the use of effective interest method. This is a long discussed issue, whether it is allowed, Sharia allows for the use of interest as benchmark in reporting and in reporting basically. Okay, and issue 3, we will look into the Sharia acceptability of expected credit loss model for equity-based financial instruments such as mudarabah and musyarakah, because in the new IFRS 9, we have a new requirement that a financial asset should be impaired using expected credit loss model rather than the loss incurred model that was practiced before. So we'll look into the Sharia acceptability of that expected credit loss model. And finally, we go into the Sharia issue on fair value measurement of financial instruments, because fair value basically it's good to have fair value measurement, but we have some measurement issues when we would like to consider fair value in order to reflect the value of financial assets that we have. Okay, so we go straight. I would like to, remind you basically on the, previous lecture that I delivered on the scope of scope of Sharia assurance. We have the model that I presented last 2 weeks on, we have the internal, the box in the middle there, the internal Sharia audit. We have the role of internal Sharia audit function, and we have the role of external Sharia audit function. And for the internal Sharia audit function, we've learned that this function is actually will ensure internal control and operational audit in terms of financial issues. But in addition, we have also external Sharia audit function that will audit the financial statement in Islamic financial institutions. Thus, the focus for today's basically presentation is to look into the issues, specific issues on the audit of financial statement, which we will look into the IFRS 9 issues in Islamic financial instruments. Okay, for the classification and measurement, this is the basic for IFRS 9. IFRS 9 prescribes that financial assets should be classified either, using amortized cost, fair value through profit and loss, or fair value via other comprehensive income. And the selection of this option is actually based on 2 factors. That is, it will depend on the contractual cash flow characteristic test and the business model option. So both of these factors are affecting the option on how to classify and how to measure Islamic financial assets. Whether it is to be classified or measured as amortized cost, fair value through profit and loss, or fair value through other comprehensive income. And I will further discuss this in diagram 1 that was produced basically by IFRS in the summary projects. Okay, and we know that financial assets in Islamic financial institutions contains of several types. Some are held for trading, some are held until maturity, some are put into the category of available for sale, and some are actually financing and receivables. So it is the focus of this paper to look into the Islamic financing and receivables that are due to Islamic financial institutions. Okay, so this is the diagram that I was talking about. If we look at the apex there, financial assets, when it could be divided into 2. This is the first layer of test is contractual cash flow. CCF is contractual cash flow. We have to know the characteristic, whether it is solely for payment of principal and interest, or in short we call it SPPI. And another category is whether the contractual cash flow is not solely the payment of principal and interest. And I will later discuss the SPPI issue in the next slides later. But let's see now, financial assets consist of these 2, whether contractual cash flow consists solely the payment of principal and interest, or is it not. If it is, then we have another layer of test that is, it depends on the business model of the Islamic financial institutions, whether that financial asset is actually held in order to collect contractual cash flow only, or is it held to collect contractual cash flow and for sale at the same time. So from that 2 layer of tests, contractual cash flow test and then the business model test, and we will have the option. If it is using fair value option, then it will be later treated as fair value through profit and loss. That is the second box, to the left. And if it's not, then it will be using the amortized cost option. Okay, and if it is held to collect contractual cash flow, and as well as it is available for sale, then it will be one of these two options. If it is using fair value, option, then it is will be fair value through profit and loss. And if it's not, it will be fair value through other comprehensive income. So the lines there indicates whether it's using fair value or is it not using fair value. Okay, and we have another option. That is another situation that contractual cash flow is not solely the payment of interest. I mean, we cannot consider that certain financial assets in Islamic financial institutions are basically the payment of fixed rate of return that are producing the cash flow. So it is not a solely payment of principal and interest. These are, for example, the financial assets that are based on musyarakah and mudharabah instruments, so that the return from that financial asset wouldn't be fixed, and it is not amount to fixed rate of return that we equate it to interest. So for this type of financial assets, it will be considered as fair value. It will be recorded as fair value through profit and loss. And I will discuss about the types of financial assets, Islamic financial assets, and how we will record it, whether it's through amortized cost or fair value through profit and loss. If you still can remember on the when I did introduce on the outline, so now we have several issues on the classification and measurement. Now we are going into the issue 1 under classification and measurement issue. That the type of financial instruments. We will go into the discussion of type of financial instruments and how it is affecting the measurement treatment. That is, we will look into whether these Islamic financial instruments are applicable to SPPI test, that is solely for the payment of principal and interest test. Okay, according to IFRS, for contractual cash flow to be SPPI, they must include return consistent with the basic lending arrangement. So for example, if the contractual cash flow include return for equity price risk, then that would not be consistent with SPPI. So if you think about it, we have the Islamic financial assets that are having equity price risk, that are suffering from equity price risk. For example, we have the mudharabah and musyarakah based financial assets. So based from the definition by IFRS, so this financial asset will not be included under the definition of SPPI, that is solely for the payment of principal and interest, because the rate of return for this equity-based financial assets are basically it varies rather than it is fixed as in murabahah and tawarruk. Okay, and in terms of recognition of financial asset itself, the whether we're gonna have we're gonna record it and measure it and classify or measure it using fair value or amortized cost, it depends on the types of return of that financial asset. If the rate of return is based on indicative rate of return with actual return paid to investors, and it is possible to measure that at amortized cost, because it closely resembles payment of principal and interest. This is, the research. I took it from the research from AUSOC, that is a Islamic finance research group that are focusing on the research in Islamic financial reporting, and as well as from KFH research in 2012. If it's an indicative return and that base with actual rate of return paid to investors, then it will be likely that it will be measured at amortized cost. But if the rate of return is based on profit generated by investee, it will be recorded as fair value because it doesn't represent solely payments of principal and interest, because again the rate is fluctuating and is depending on the profit performance of that financial assets. Okay, so I've finished with the explanation on the types of financial asset and whether that financial asset should become, will satisfy the SPPI test, solely the payment of principal and interest test. Now we go to issue number 2, that is, it's like I highlighted, contract using rate of interest as a benchmark to equate a rate of return for Islamic financial instruments was problematic, and it raised a lot of discussion. So in this contractual cash flow characteristic test that has been highlighted in IFRS, it again raised the issue of the allowability of interest, revenue and expense, and the use of effective interest method. Okay, and we know that for the rate of interest, it is an acceptable element in contracts of exchange to uphold the element of justice or al-adl between contracting parties, but it is not acceptable to charge an extra sum for the deferred payment of card or loan. So it means that time value of money could be applied to the contract of exchange or the sale contract, but not to the card contract, that is. Okay, and this view is upheld by Sharia Advisory Council of Bank Negara Malaysia and other authorities of fatwa. And we actually, myself and the research team from ISRA, International Sharia Research Academy in Kuala Lumpur, we produced this research report that discussing about time value of money and the selected fatwas about in the purview of Islamic financial assets in this issue. So if you would like to have more readings on that, you could refer to the research report that was published back in 2014, last year publication. However, there is no specific fatwa regarding the discounting process and permissibility to use interest rate in accounting, in discounting, because we were discussing about the use of time value of money in sale contract and loan contract, but the discussion on the use of time value of money and the use of interest rate in discounting process are not really final. Okay, so yeah, when we have this Sharia problem, not Sharia problem, we have Sharia issue in this, the use of interest rate as an indication to use the test of contractual cash flow, then we have this issue that we have to think about, as an external auditors. Okay, and I will go to the third issue of classification and measurement, that is the issue of Sharia acceptability of expected credit loss model for equity-based financial instruments such as mudarabah and musyarakah. Again, for Islamic financial assets, there is a need to impair the financial assets, and we have two types of impairment models, that is the incurred loss model and the expected credit loss model. And IFRS 9 has introduced the expected credit loss model, to basically to improve for the measurement of financial assets to be more robust in the light of financial crisis. So we have now to use expected credit loss in order to impair the financial assets. we know that in incurred loss model, the impairment or the writing down of the value of financial asset is provided upon loss or trigger event when it is really identified, when it is really happened. But expected credit loss model, the impairment is happening based on the expected credit loss before the occurrence of credit loss event itself. So, incurred is based on previous incurred event, or an expected loss is, the determination of expected credit loss for that financial assets, basically. Okay, for the treatment of expected credit loss model, the expected treatment is for initial recognition. The company will estimate expected credit loss for the whole life of the asset, for the total expected loss for the whole life of the asset, and recognize the loss allowance equal to 12 months expected credit losses. And that is for initial recognition. But for subsequent recognition, if the credit risk increase significantly, then we will recognize loss equal to a lifetime expected credit loss that we have initially recognized before. And if the credit risk has not increased significantly, then as in the previous year, we continue to recognize in the next 12 months of expected credit loss that had been set in the previous year. Okay, but for the, this expected credit loss suggestion or a proposal raise, the Sharia discussion, because, in Sharia, when we have the Mudarabah venture, the profit will be determined at the end of the period based on, the incurred expenses that had been recognized. So it will be, the profit will be determined actually at the end of the period. But with this expected credit loss, it is not. It's really different with the actual expenses that had happened. So Sharia acceptance on expected credit loss is only acceptable for only reporting purpose. And the discussion of expected credit loss model from a Sharia perspective could be discussed from the point of view of profit determination, because not many discussions are really performed on the expected credit losses from the Sharia point of view. So we go to the discussion on profit determination when we would like to discuss expected credit loss model. So we kind of indirectly deals the issue of loss model when we discuss the determination of profit from Sharia point of view. Okay, and from Sharia point of view, actual profit is calculated from relevant financial assets rather than on predetermined interest rate or predetermined event, and it is an allowable deduction for profit determination, and we use probability of default rather than actual default or credit loss. Means that Sharia recognize probability of default because we have a probability of Shah of Waham, and that is the instrument that we use in order to determine the profit of the financial instruments, rather than we look into the actual default or credit loss, expected credit loss. So that is the Sharia stand. Okay, and we go also on to the discussion of profit determination, and this is profit determination provision by Negara Malaysia. That is, this comes from Sharia standard on Mudarabah. Okay, when we are determining profit, it is it has two options. First, that is realized basis, that is, for partnership contract or mudarabah contract, it is when we have the actual liquidation of the asset, then the profit determination is done after that, after the actual liquidation of the assets of mudarabah partnership. Or we could do on the constructive basis, and this is, it's sometimes it's not possible to wait until the actual liquidation of the asset, because some assets are held in many accounting periods, so it's not possible to liquidate at the end of year one and then liquidate it again at the end of year two. So we perform constructive basis or progressive method. Okay, and this method is acceptable. It is acceptable to use the valuation according to acceptable market methodology, independent valuation, or valuation based on estimated figures. That is, the rate of return for profit determination could be based on this acceptable market methodology. And also direct expenses that are identifiable and measurable with regard to specific investment activity are allowed to be considered when determining the profit in Sharia contracts. Okay, those are for, the basically variables or the discussion on profit determination that was done or provided by Bank Negara Malaysia Syariah Standard or Mudarabah. And IOFI, is in the same opinion. Basically, IOFI Syariah Standard number 13 and on Mudarabah say that determination of profit will either be based on realized profit, that is actual or constructive valuation, as provided by Bank Negara as well. And however, there is no further discussion on the criteria of expenditure that qualifies for determining the profit figure. So, it's either the determination of profit is based on the realized profit or based on constructive valuations. So both Bank Negara Syariah Standards and IOFI is having the same stand on the profit determination. So basically, we don't have a lot of discussion on the use of expected credit loss model in order to impair Islamic financial assets. So we have to really look into the profit determination by these regulators, basically a regulator and accounting regulator, to look into the, this is only what we have on the profit determination criteria. Okay, so I basically have discussed the issues regarding to the classification and measurement that is basically provided in IFRS. That is, on the type of financial assets and whether that type of financial asset fit for the test of solely payment of principal and interest. And we have the issue of, whether the test for cash flow, this will raise the issue of the use or the allowability of interest rate, the use of effective interest rate, and the third issue on the Sharia acceptability on the expected credit loss model. And now I'm going into the last portion of the presentation, that is on the Sharia issue on fair value measurement of financial instruments, because basically IFRS 9 is favoring fair value measurement in order to reflect better, to measure better Islamic financial assets or financial assets. But we have some Sharia concern on fair value. The determination of fair value because we have the 3 levels of determination of fair value, and I will discuss this issue, what are the Sharia concerns on this fair value measurement. Okay, and fair value measurement is used or has been used by jurists in deducing rulings on the determination of zakat payment, because for zakat it has to be market value, and market value is fair value. And and scholars agree that role of the use on the use of estimation techniques in the determination of fair value when there is no clear market price for the commodity. That is, when we are using fair value measurement but we don't have the market value, then we have to use some estimation technique in order to determine the fair value. And the thing is, we have the controversy on the use of discount rate within the estimation techniques. That is, when we don't have the market value, and the company is bound to evaluate or estimate its own fair value for the financial assets, but it use discount rates within these estimation techniques in order to come with the fair value estimation. So, and we have this hierarchy of preferences for measurement of fair value. So the preferable one is level 1. This is a clear market indication for the measurement of financial assets that we have, because at this level our financial assets are basically quoted in active market, and this is true for financial assets that are tradable. But in the case that we have financing and other receivables, this might not be the case. And for level 2, we have the quoted price of related asset. We don't have market value for that, but we could actually look into other assets and observe the value, and we equate that to the market value of our own assets. So we call this as observable market inputs. And level 3, fair value measurement, which is the least favorable measurement, that is, using our own company estimates based on unobservable market inputs. So company will resort to using their own measurement, using own interest rate in order to come up with the fair value of its own assets, which is basically not really equated to market practice. Okay, and the level 3 model we call also income approach rather than market approach. Okay, and it has many technical measurement problems because it relies heavily on judgment, especially on the amount of cash flow, the timing of cash flow, and the risk associated with cash flow. And this may result in misrepresentation in the determination of fair value. So this is a research by ZAC 2009. And so come to think of it, the company has the decision on to decide what is the amount of cash flow itself, the timing of cash flow and the risk associated with cash flow. So it really depends on the company to judge. So it is, they are using unobservable market, basically benchmark in order when they would like to measure the fair value of their own assets. Okay, and so that's why for level 2 and level 3, that is unquoted, quoted price of related asset, and the own estimation or unobservable market input, it is highly possible to to be involved in gharar as compared as to level 1 fair value measurement. Because in level 1 fair value measurement, it's obvious that the fair value of the asset is measured based on the quoted price in active market. So we don't have basically gharar in that sense. But level 2 and level 3, when our own estimate will be imposed to determine the fair value, then we will have element of gharar in that. Okay, so I've discussed several issues on the IFRS 9 application to Islamic financial instruments, which I put three issues or discussion on the classification and measurement, and I've discussed also on the element of gharar in the fair value measurement in financial assets. So as for the conclusion, we could say that some financial instruments do not fit to be categorized under contractual cash flow or solely payment of principal and interest. This is because Islamic financial instruments, we have types of Islamic financial instruments that are based on mudarabah and musyarakah, that having a variable rate rather than fixed rate, that it carries variable rate rather than fixed rate. So it doesn't actually fit into the categorization of solely payment of principal and interest. So it doesn't fit to be considered as one. Okay, and because of the use of the problematic, because it is problematic to use interest rate as benchmark, so we conclude that the use of rate of return is more favorable than using interest rate as benchmark to perform contractual cash flow characteristic test. So we recall back that IFRS 9 has two types of tests, that is the contractual cash flow test and business model test. And for the first layer that is used, we would like to know the contractual cash flow characteristic, then it is better to use rate of return rather than interest rate, so that it will not trigger Sharia issue. However, there is no clear issue on the Sharia, no clear discussion on the Sharia acceptability on expected credit loss model for equity-based financial instruments, because we have only discussion on how to determine profit that was discussed by Bank Negara Malaysia standards on mudarabah, and also by IOFI. So this is basically a very good area of research that we could do, that is to examine, to further examine on the Sharia acceptability on expected credit loss model that is now discussed or is provided in IFRS 9. Okay, and as for fair value measurement, we've discussed just now that we don't have a problem with fair value at level 1, which is based on market price of that financial asset, but we have problem or Sharia issues when it comes to level 2 and level 3 fair value measurement. That is, when we have we equate to observable price, but observable price of related asset rather than of that type of specific type of asset. And at level 3, the determination of fair value is really based on own company estimates. So that introduce lots of gharar element in the fair value measurement. So I think that's it for my presentation today, and I've concluded. So will I take questions or? So to all listeners, do you have any question on the application of IFRS 9 on Islamic financial instruments? I think if there is no question, so we could, I will conclude the session. Yes. Okay, I think that's all. Okay. There are some basically inquiry here. Brother Amir Abbas was asking how you value mudarabah and musyarakah while the profit is not certain and fixed. Yeah, because mudarabah and musyarakah is a contract that actually the rate is to be determined at the end of the contract period. So only at the end we will know what are the performance of that instruments, and with that when we conclude at the end of the period, then we will know everything, how it is performed, and then how much cost that had been incurred and so on. So that is actually the best way to basically calculate the profit for mudarabah and musyarakah. But because of in the it is impractical to do so, we will use the previous rate of return as benchmark to pay the return for that period of time, and at the end of the mudarabah and musyarakah period, and then we will adjust based on the actual performance. So we have, for example, previous rate of 5%, and then we will be using that as benchmark, and we will continue to pay 5%, and towards the end of the contract, then only we like kind of adjust to the actual performance that is to be decided later. So that will solve the problem of because we don't know the rate of profit for mudarabah and musyarakah. So the best that we could do, if you would like to determine or would like to pay the amount of profit yearly, is to basically having certain benchmark, and towards the end only we basically jive that benchmark to the actual performance. Okay, that was the question by Brother Amir Abbas. Okay, and Brother Akmal was asking fair value versus amortized costs in the slides. He wants me to elaborate about the criteria for accounting, specifically sukuk portfolio, or whether there is any accounting standard on this matter. Okay, I'll respond to that. Because IFRS is a principle-based standard, so it will not address the issue of specific financial assets, basically. So I mean, and so we don't have specific standard for sukuk in terms of accounting. There is no accounting standard that that deals with sukuk portfolio. But we have regulators guidelines, but it's not a lot on accounting point of view, but more on the valuation, and I mean, first from how it is issued, what are the instruments that we could use, or the concept that we could use, and how it is to be reported, basically. So I mean, to answer your question, we don't have like specific accounting standards for sukuk. issued by IFRS. Okay. And you asked as well, Brother Ikmal, that that I mentioned that interest rate benchmark is problematic, and you would like to you would like for me to discuss the reason why. Because interest rate, first is Islamic financial assets are not necessarily consist of fixed rate. It doesn't really consist only of fixed rate return, because we have mudarabah, we have musyarakah contract or musyarakah mutanakisah that has a variable rate of return. So to equate the return with and a rate that is fixed is really not doing justice to this type of financial assets. So that's why it is problematic if we are using the interest rate as benchmark of this type of financial asset, which unfortunately we have problem in regarding this issue with the conventional accounting standards. Because for the conventional accounting, and financial instruments mostly consist of, all of them consist of fixed rate of return. Come to think about it, if you think about it, all loans have a fixed rate of interest. So that is, the conventional practice. But for Islamic financial instruments, financing, on the other hand, consists of basically some are tawarruk, using tawarruk, some are using commodity murabaha, and some are using equity type of instruments. For example, musyarakah mutanakisah as the basis for that financing. So the rate will not be fixed. Okay, and I have one more question from Brother Muhammad Yusri. So I read the question. Yeah, from accounting perspective, is it possible to structure sukuk as an equity instrument, given that the test for cash flow payment and business model are fitting well with that instrument only? Yes, because we have, like I have discussed before, that contractual cash flow, solely payment of principal and interest, really jive with the IFRS 9 measurement. So we will use that as PPI test only for fixed rate instrument. So having said that, of course, I could only say that because I cannot say that whether it's good to have sukuk. It's better to structure sukuk as an equity instrument. We could structure sukuk as an equity instrument, but it will not use the SPPI test. But rather, if you refer to the slides on the 3 slides, that when we have financial assets, I'm referring to the slides now. When we have the okay, let me have a look at the slide. When we have the contractual cash flow, not solely the payment of principal and interest, that is, for financial instruments that are that has variable rate of return, then we could choose this option of recognizing the fluctuation of the value through fair value through profit and loss, based on the slides number 1, 2, 3, 4, 5, slide number 5, which is diagram 1 that I've presented just now. Okay, I hope I've enlightened the issue that you are posting in the question section here. Okay, I think if we don't have, I mean, the listeners don't have any more questions, so I conclude now. Thank you very much for participating in this session. Yeah, I hope I'll be able to do this again, inshallah, in the future. Okay, Assalamualaikum warahmatullahi wabarakatuh.